So hello and I'll welcome you to today's special webinar, the NFPs ahead and which scenarios to expect. And yeah, so I think you can respectively should hear me special web well. So at least I can hear myself well here in the background at another screen. And yeah, so in fact, this is the day before the NFPs, and we just thought it's probably worth to give it a try and to probably switch this format to a special webinar around the NFPs and again what to expect here, which scenarios to expect. Mainly due to the fact that the volatility in the U.S. equity markets is not that huge. In fact, just to give you an update here. October was the least volatile month ever in the history of the U.S. equity markets. I'm sorry. Yeah, but probably this is not so bad. So, but before we come here to this slide, let's just have a look at an article. And in fact, I haven't prepared this article. That's something I have to admit here. So let's have a look here at Twitter. And it was an article yesterday. It was an article yesterday, which was published here on Zero Hedge. By the way, I just saw a question here. That's on a trading technique. It's how I scale in, respectively, how I scale out of positions. I'll go into further details here. After, first of all, here we had a look at this article from yesterday, and then we'll answer this question. I'll answer in short, and then we'll go over to the different scenarios here for the NFPs. I think this is fine with everyone. So 2 hours. So you've seen that the Bank of England just hiked rates the first time after 2007. So the first time in 10 years. And in fact, GBP is selling off aggressively. And some of you might wonder why this is the case. It has to do with the fact that it was a quite dovish hike, in fact. Okay, one sec. This is taking too long here. Let's do it a different way. Let's go here. Zero Hedge, October least volatile. That should get the job done. October is now the lowest on record. That was the 10th of October. Let's have a look here at news. The whale turned. No, that's a little unfortunate. This is fun. Oh yeah, here, there we go. There we go. So 20 minutes ago. It's official. October was the calmest stock market month ever. So usually, in fact, October is one of the, if not the most volatile month, showing over 30% of the days on average having a trading range of more than 1%. That was something I presented to you guys around 1 month ago. And it was some hope there that now, after a very, very calm summer, respectively also September, that we finally get some volatility. And yeah. So October is usually, from a statistical standpoint, a good month to hope for volatility picking up. But unfortunately, it turned out the complete opposite, and October was the least volatile ever. So here's the monthly average VIX. You can see it here, and you can see here that that was October. So it's in fact, yeah, it's in fact something we should always keep in mind here. And I can see this also in my trading. So in fact, you may remember that I told you several times that I have, I'll give you here, I'll give you here the S&P on a 50-minute time frame. And by the way, we'll formulate probably also a trading setup here. So we'll mix things up a little, but nevertheless, the main focus will be on the NFPs. So I can see this in my own trading, because the thing is that were not many trading signals here generated in October. And this resulted, in fact, in me mainly focusing here on the DAX. And yeah, so this is something, hopefully, it will change rather sooner than later. Nevertheless, so far, it doesn't look that promising. And so we decided to somehow switch this live trading of the US market opening here to at least once a month at or right before the first Friday of the month to an event which focuses here mainly on the NFPs. But before we switch over to the NFPs, and I love the introduction. I waited a week for this question, so I have to answer it right now then. How to scale in and how to scale out of a position. 1 second. So I'll use Paint for this to draw a chart and then try to explain this. So let's just imagine that your trading approach is a market structure trading approach or something which is Dow theory oriented. In Germany, we call this a Markttechnik. It's a market technique, but the problem is that some people might say, okay, what does this mean? What is market technique? It's you analyze the market structure. It has several aspects of Dow theory in it, but all in all, it's yeah, it's based on a trend analysis, if you want, and then you decide to open positions based on the knowledge of the market structure. And so therefore, let's just imagine the following. Let's just imagine you have a structure of higher highs and higher lows, and now let's don't let get too overcomplicate things here. So we just want to say our setup is based on the fact that we say we wait for a structure to develop with higher highs and higher lows, and if the market then comes back and retraces to the former highs, accepting them as a support now, or if you look at the downtrend, then you respect them as a resist. You enter positions here. Okay, so this is where you take the long position, and I just do it that way. So long, and now this is the setup, and now imagine that you're taking a position which is like 1 second. Let's try if this works. No, that doesn't work. I'm sorry. Why not taking the pyramid here? That probably makes the most sense. And now it's called pyramid or scaling into a position because you add smaller pieces to an already existing position. Meaning, just imagine here you're going long, and now I'll put a 4 here, and that means you're buying 4 contracts. So we are not looking at the risk and money management in terms of how much to risk here and that stuff, but we just look at it from a pure how many contracts do we buy here perspective. So we're buying 4 contracts here, and now the thing is that you can say, okay, I have my setup here, and I'm buying once the market forthrights the structure of higher highs and higher lows, and if it comes back to the former highs, then I'm adding to this position here. In this case, it would be here. So if the market comes back to these highs, then the market you will enter another long position here in this region. Meaning now you're buying a pyramid, meaning that, for example, you're taking 2 contracts here, and that means you're buying here too. And just now, let's say, click. Now just think the market comes back here again, and then running higher again. You'll do this a 3rd time here. After the market forthrights this sequence of higher highs and higher lows, pull back to former highs, you're buying another position here, adding it here. So there's the 1 then. And then you're not adding anymore. And the reason you do that is, by the way, that the trend grows older. So you don't want to be too aggressive once the market has already shown a sequence of higher highs and higher lows here, and has it took some time to develop the trend structure here. So you're getting less and less aggressive here once the market adds another progression here in this case. And this is how you scale into a position. This is just a market structure approach. You can easily adapt this here to every other trading approach and your trading approach. So you use strategy, your trading, that you just see, okay, what are the parameters for me to open a position in a long and a short position, and how can I add here to this position? I have several other rules I live by. First of all, for example, I don't add to losing positions. That means the position here has to show a profit once I add to this position. Second is, if I enter the second position here, I have to calculate the whole risk of the whole position here, meaning that if I, let's say, risk here in the first step, I'm risking 1,000 euros. The risk when taking on the second position here should be lower than those initial 1,000 euros. For example, you don't want to exceed this initial risk of 1,000 euros here. Yeah, this is what we call scale out. So first of all, we're talking about scale in here. No, everything's fine. So don't worry. If you have any questions, please ask. It's no problem at all. Now the question, but if it goes against you, would you cut your first trade to cut the risk? So this is something we can't go into too much details here, but this is something you could add to your trading plan. Nevertheless, we want to say that, for example, the market won't move in your direction now. So usually what you'll do then is, if you're at the first position here, so here's your first stop level. And now if the market builds the structure and you're going along here with this stop here and moves to higher highs, then you can move the stop here to this former relative low. And this is the place where the whole position will see it stop then. Meaning, so if the market comes back here and the long position, you take the second long position here, then the stop for the second long position is here in this region. So let me do this probably in red here. So then it's the red point. If the market moves to higher highs, then I take another long position here. So just writing a 1 here. Then the stop moves to the next level, which is here. And this is already then the point where you can imagine the position to show a profit, since the average price might be somewhere here. So that means you're moving your stop then already in the winning zone. And if you add another position here and the market moves to higher highs, then you move the stop to this level, for example. So what this perfectly shows is that you have to have a clear plan. First of all, how to enter position, but also how to exit the position. Meaning you have to really know your exit management out of a trade, and how to trail the stop, and how to grow potential winning trades. So yeah, this is how you could imagine the topic around scale in or permitting a position. Now let's go here and clear this, and now think about it that way. So just imagine you're having such a position here, and then in the market you're entering. Again, same structure. You're entering this position here. So here is the entry point. Here's your initial stop. So this is the initial risk you're taking then. Okay, so this is the distance. And we call this R, or risk. It's 1R, however you call this. So now the thing is, probably the market moves in your favor at the first moment here, and then it doesn't make it to new highs, meaning you can't move your stop, since you have to wait until the market forthrights the structure of higher highs and higher lows. So now the market does the following: it starts to move in your direction, but then turning around. I have, for example, the rule I live by. I usually move my stop to break even once I earned my initial risk. So it could be that this initial reaction here already means I'm earning 1R here, and that way I'm capable of moving a stop to break even. But now let's assume that's not the case in this case here. And so the market, well, then starts to push lower, and unfortunately not showing a profit. So what you could do then is, for example, that you say, after the market moved 1 0.5 percent, 1/2 or 0.5 or 50% against you. So let's say 1R equals to 30 points. If the market then moves against you after probably immediately or initially moving in your direction, or if it, let's say, just moves lower from there, doesn't matter. But if the market moves 50% against you, 50% of the initial risk, then you do the following. There's something you have to really see in your trading journal. But what you could do is you could take out half of the position. So let's say you're initially buying for contracts. If the market does exactly that, moving 50% of your initial risk here, 1R against you, then you cut the position by 50% too, moving the stop to, moving the position here to 2 contracts. So taking out or realizing the loss for 2 contracts and keep on the rest of the position here. So the thing about this is the following, and the target is with a scale out, it's the different, or it's the opposite from a scale in. So the topic you're looking at here is that you try to optimize your expected value that way. And this could be done by here, in this case, just imagine you're reducing the risk here by 50% after market moves 50% of the initial risk against you. Then you could say, okay, I'm taking out half of the position here, and meaning that my initial risk, which might be, let's say 1,000 euros, then drops to 750 euros. You might now say, well, does it really matter if I'm saving 250 euros here? Well, yes, it does, in fact, and therefore I can show you a graphic. Just one second. I just have to see where I have it. Let's see. Yeah, perfect. Awesome. So it takes a little. So where is it? Here. So I showed to you 2 charts, 2 graphics here from a simulated example, but it shows that it works. So what you can see here is, unfortunately, it's in German. So I just saw, let me do it that way. No, that's not good. Let's work with an English chart here. So I have also one in English. And so there we go. So what you can see here is in blue, you have the equity growth with a scale out, while you have in red an example of the equity growth without a scale out. And what you can see is that by reducing your position size that way, or also there's another technique, you can work with the so-called time scale out. The time scale out means that you have a clear idea of how long on average your trade takes. That's why you have to have a trading journal here, a very detailed trading journal. And let's say the average period of a trade is something like, I don't know, 2 hours. And after 1 hour, the trade doesn't show a profit. It doesn't show a loss either. It could be that the trade is trading around break even or something. But nevertheless, it doesn't give you the feedback you need for a positive trade. So imagine you're long, then you want to see the market rise as soon as possible. And if the market doesn't move in your favor, well, then probably it's time to take out half of the position here, scaling out, or a third of a position, or 3/4 of a position. Depends on your trading plan. And it perfectly shows that it's a long way to go to optimize your strategy that way. But if you do it, then you can see that potential drawdowns are reduced here. So the blue line obviously shows a drawdown, but nevertheless, it's not as huge as it is in the red line when you're working without a scale out. And on the other hand, that means nothing more than the market is obvious, or the equity curve in this case, is moving to new equity highs faster. So that's the idea behind the scale out. So all in all, scaling in and scaling out of positions aims on optimizing the expected value of your trading strategy. Yeah, and you can already see that this is obviously a very deep topic. I'll give you the following hint here. have a look at my website. It's jk-trading.com, and there you find under Ausbildung. It's a German website, but the part, no, let's do it the other way. You can go here to the shop. You can go to the shop, and there you can see that I'm offering several products here. For example, I Trade Like a Pro, the online course. So it's the whole course. It's not just trading strategies or techniques, but it's also risk and money management and the theory behind scaling in, scaling out of positions. So it's part of this. But you can easily also send me an email, and we can talk about taking out the module here around the risk and money management. So I offer the whole course in German, for example, but you can see here that I'm also offering all the section, the modules here of this course. I'm offering them separately. We can do the same here in English too. So I'm very flexible here. If you're interested in that, just send me an email, and we can discuss this in further details if you want. Yeah, and so I just hope that this answers your question. And these are questions. I'm a little sorry, but really I just wanted to focus here on the NFP. So the thing is, I have so much to tell you about this topic, not just scaling in, scaling out, but also, and I think this question perfectly shows that there is a high demand for information around this topic here. So how many positions would you take before considered it to be too aggressive? So it depends. You can't answer this question with clear details, but usually you should be also really careful when scaling into positions. So we made it really easy. We just said, okay, the market shows itself the way it does here, but the problem about this approach is that you just have to see whether it really makes sense. If the overall market conditions suit building a pyramid here or scaling into a position really well. So usually you should always, when you should consider doing this once the market shows a really clear and good structure. But that's not everything here. But on top of that, you should also be mentally really at your highest possible game, and your equity curve should be rising, showing that your trading approach obviously correlates really well with the current or corresponds really well with the current market conditions. And all this has to be taken into account here when considering building a pyramid here or scaling into the position, for example. And this also has or impacts, for example, on when I consider position to be too aggressive, since it could be that there are market conditions when I consider a position to be too aggressive, while in other market conditions, very favorable market conditions for my trading approach, I don't see this problem at all. And I'm building, I'm seeing not the conditions I want to see. And that's one of the reasons why I don't take on a pyramid here or scale too aggressive into a position. So it's a very difficult question to answer in a short period of time. Yeah, and that's so. I just hope that you're not too frustrated about this. But it's really difficult to answer this right here, especially if we want to. And this is something I definitely want to present to you, since I took some time here to build something in terms of a presentation for the NFPs tomorrow. So let's have a look here at those NFPs. And the question right at the top here: why are the NFPs tomorrow interesting to watch? And why are they important? So looking at the Fed statement on Wednesday, which didn't deliver anything new in terms of a potential rate hike, the NFPs on Friday are one of the last chances to change something here in terms of rate hike. Even, I mean, no, they are not even capable of doing that. So the NFPs tomorrow won't change anything. There will be a rate hike of the Fed in December. Full stop. That's it. So meaning right now the market here, and this is a graphic I sniped out of the Fed Watch tool on the website, from the CME group here. So it's showing how likely market participants see the Fed to hike rates in December. And what you can see here is the current market, the current rate level. can be found at 100 to 125 basis points. So meaning they are seeing a rate hike by 98% of the they're seeing a rate hike by 98%. So that way. And so even if the NFPs disappoint tomorrow, similar to what we've seen here last month, it's nevertheless the case that the Fed won't change that much, even though such a disappointing data set, for example, as the month before, when we lost 33,000 jobs here in September, mainly due to the situation around the what's the word for this? Hurricane. Yes, the hurricane here. Even if we get to see such a huge and disappointing data set, the Fed will hike rates, even though it will probably reduce the expectations for 2018 in terms of rate hikes from the Fed, which could then weigh negatively on the US dollar. But this is something I'll present to you in the scenarios here. Nevertheless, NFPs are obviously interesting to watch, and this is something you can see here. So it's not just something in terms of market expectation around a hike in December, which won't change that much, but also what to expect in 2018. So usually, and this is what I talk about a lot in the morning meetings, but also towards my students here in my educational courses. So I tell the people, well, what's important is you really have to look, what does the market expect? And this is, in fact, what could then trigger bigger moves. So, and the great thing today is that we can easily have a look here at the situation in the, by the way, let's have a look here at the DAX. That's one of the main markets I'm watching, and that's one of the reasons why why I usually want to have a look here. So dropping to new daily lows, S&P a little lower than that. So in fact, I promised, by the way, I just promised to you to give you a setup here. So you may remember the live trading events where I usually present the setup. So this is something we won't discuss now, but let's just make long thing short here. So the high can be found 575.5. So this is the high of the open range. So that way. And the low is here, 2,562. Wow, this is, I mean, I'm surprised, since usually, or it's not unusual, let's say, that during the last weeks and months, the open range was smaller, sometimes as small as 3 points. And now we're having an open range here of 13.5. This is, well, this is huge. So, where the low volatility. So, but nevertheless, so just give you the technical setup here. So that's the risk. It's 75 point. So the reason I'm capable of doing this here that fast has to do with the fact that I exactly know the trading approach I'm trading here. You may remember the 3 rules you live by here. It's just saying, okay, I take the high and the low between in this case, it's 2:30 p.m. GMT till 3:15 p.m. GMT. And then you're saying, okay, I take the high and low. If it's bigger than 5, and right now 5.5 points, then I'm going long once the market breaks out of the open range on the upside. And on top of that is trading above the exponential moving average here, 10 on a 50-minute time frame. And I'm going short if we break below the low of this range here and trading below the exponential moving average 10 on a 50-minute time frame. And I know that this is a profitable approach. In fact, has a hit rate of 47%, a payoff of 1.3 to 1, meaning the average winner compared to the average loser, giving us a positive expected value of 8 cents per euro, US dollar, British pound, Japanese yen, whatever we risk here. Meaning that, let's say we are risking 1,000 euros, meaning I'm making on average 80 euros per trade. and it doesn't matter if it's a winning trade or a losing trade. And we can back test this strategy back towards November 2010. So we tested this already for over 7 years under different market conditions, and it shows that it's profitable trading approach. And that's one of the reasons if you keep on moving, keep on doing this over and over again, you become what in the trading psychology world we call unconsciously competent. So it's just like breathing in, breathing out, driving a car, something you do over and over again. And that's one of the reasons you can just do exactly that, what I'm just doing here. But nevertheless, you have to do this over and over again. It's not that you just take the setup now and say, okay, I traded once. I presented this already several times when we started out with this program here, with this webinar format. I think that was in June or July, I'm not sure. And we started out with potential setups here. I've shown to you that the first 4 setups were all losers. And I could imagine some people just saying, okay, what is this? I mean, it's a strategy, simple strategy, and obviously it's not working, but we just generated 4 losing trades. The interesting thing is that in the meantime, it turned around and it has a hit rate of something like 40%. So the current market conditions are not really well for this approach. Nevertheless, it shows a quite attractive profit. I haven't double checked it now for quite a while, but nevertheless, it still shows a profit, a very attractive profit, especially for those not so perfect market conditions in which we are currently trading. And so yeah, the target. Let's have a look where we could, what is potential region we could look at. So usually I'd say, well, why not expect a push as low as 2,540 points? But this probably is a little too aggressive, even though a quite wide open range suggests that there's enough, especially on the downside, with pushing the S&P on the downside, that it suggests that there's probably some potential for the downside. And somehow, let's say we know that in the evening, Donald Trump will announce the next Fed chair, meaning that if he goes for a hawkish candidate, even though this is unlikely, there's a guy having a high likelihood to be chosen called Powell. And he's similar in his monetary policy approach to Janet Yellen. So if he chooses him, we won't get to see huge volatility. But if he surprises here and brings us some hawk, like this Taylor guy, the professor here from the Stanford University, who has a rule called the Taylor rule, seeing the Fed funds rates currently, the fair level of the Fed funds rates at 5.75 instead of 1 to 1.25% in terms of rates here. Well, this could trigger definitely some volatility. And we know that the market is highly leveraged right now. Therefore, just Google the word NYSE leverage. So NYSE and then leverage. And you'll find out that the current leverage here in the markets is extremely high. Meaning if we are hiking rates now too aggressively, or the market anticipates a more hawkish stance of the Fed then in the next year, once again, remember back, that has somehow to do with the NFPs tomorrow, then this could trigger some bigger action on the downside. So it could be that into the evening here, we probably get to see some bigger moves on the downside. Nevertheless, the thing is that I usually work with the following. Even though I consider chances to be good, that probably market could drop 20 points and in fact bringing us a positive expected value. Nevertheless, my approach is a little different from that, meaning that I'm closing the position 10 minutes before the market closes, which is right now. 1 second, it's 1 hour back. It's 20. It's 8. It's 8 p.m. GMT. Closing position at. So automatically closing position automatically 8 p.m. GMT. So this is another approach. In fact, also a profitable one. So I've definitely talked too much now about the setup, because now we have to get back. 1 second. I just have to see what I want to present to you. It was what to expect here. Yes, let's just have a look at the potential scenarios then. So you can see here I've had a look at 3 different markets. So usually I'm also I'm bringing in here some equity markets, but in fact the thing is that right now I think equity markets have shown in the past that they are not that they are not reacting that spectacular to NFPs, but also not to Fed statements or the ECB. Even though you might say, well, did you have a look at the DAX last week? Yes, I had, and I was fortunate enough to be on the long side here. Unfortunately, my system took out the position on Thursday evening here. I had another long position then on Friday, which didn't explode the way we exploded now yesterday. But let's come back here to those 3 markets. We want to have a look at the currency markets and also at precious metals like gold, and not looking at the equity markets. And now you might wonder, where do I have these numbers from? Consensus 325, consensus range, unemployment rate, average hourly earnings. So I will show it to you. Very simple to find and very, very important. Again, now I know what I wanted to tell you. And I know that I wanted to show you what happened in GBP. So what about the market expectation? Why is to know the market expectation so important? It's so important because you can easily explain what happened here in all GBP crosses. So it's GBP USD on a 4-hour chart, but also my current favorite Euro GBP, for example, with a really huge bounce. Usually Euro GBP is not such a volatile trading a vehicle here, a currency pair. But in fact, yesterday we pushed slightly below the lows here from September and also below the lows here from July. And now seeing a huge reversal here. So in fact, I thought that probably we are about to move lower if we break below 87.50. I wasn't willing to take any positions yesterday before the BOE, but I was willing to take one position today. And I was really willing to take a position once GBP shows a bullish reaction to the decision of the Bank of England to hike rates the first time since 2007. Now, the great thing about this is the market expected this already. And I've presented this in several morning meetings. So this is something we have to remember here. What's the expectation of the market? And therefore, let's go back to Twitter again. So I've retweeted it. By the way, this guy here gave the initial chart to this. What we can see is that the market expected the Bank of England to hike rates here by 88% compared to 83% of the Fed. So right now, what we can say is that here, this is this chart. So what we can right now say is that the market, it was already a done deal. So before the Bank of England decided to hike rates today, it was already a done deal since the market really expected this move here, this step, by nearly 100%, similar to what they expect from the Fed. So don't expect markets, or especially the US dollar or gold, reacting overly aggressive to a rate hike of the Fed in December. Don't expect this. This just won't happen since the market already expects it. But the thing is, it's what you read between the lines and what's written between the lines. Or in case of the BOE today, it doesn't need to be written between the lines, but in fact, you just have to read the statement and you'll get what happened here. So they hike rates, yes, and then, and this is crucial, BOE drops line that rate may need to rise more than market expects. So this was key. So the market already expected the Bank of England to hike. What's more important is, what will the Bank of England deliver for future rate hikes here in 2018 and beyond? And well, what you can see here is, and this is in German, it's exactly this last tweet here. So this tweet, why GBP sold off. Because the market didn't expect the Bank of England to be really dovish and to not consider more hikes in the near term then. In fact, you can see it here. They are considering 2 further hikes over 3 years, which is super dovish. So, well, they just hiked and just want or hope that somehow they can overcome this overshoot in inflation here, which we've seen around two weeks ago when the numbers were published. for the UK inflation, and it showed 3% here. And we know that the target of the Bank of England is 2%. And I mentioned this several times over the last meetings here, of the Bank of England meetings, MPC meetings. They said several times that they won't accept a too aggressive overshoot here. That's one of the reasons, for example, they put in this line here in their statement before. They said, well, the market expects a rate hike. This is good, but well, probably they're not expecting as much as we're really willing to hike rates. So the expectation was really, really high that they come out with a very restrictive statement. In fact, well, they just dropped this line, and they are saying in the details here between the lines, there are probably 2 further hikes in 3 years, which is super dovish compared to what the market expected. And this is exactly the reason why GBP is coming under tremendous pressure right now, and one of the reasons why I definitely don't want to be long GBP. I mean, I have several guys here also in the German trading community who are right now considering going long GBP because they think that this is probably a too aggressive move. They are, by the way, not looking at Euro GBP or GBP USD, but more exotic currency pairs like GBP and ZD, for example. Here. So NZD came under pressure last week due to the Labour Party becoming the strongest party in the New Zealand Parliament, but also GBP Aussie dollar, for example. But I have to be honest. So, I mean, we are, from a market structure perspective, we are bullish as long as we trade above 66.80, 67, something like that. And this pullback here is probably a good chance to really get long here. So nevertheless, I don't want to be too aggressive long here. 2 reasons for that. First of all, GBP is obviously not gaining any momentum, or there is no real reason to expect the the Bank of England here to really help a GBP to gain momentum on the upside, and to gain back some of the losses we've seen post Brexit. And on the other hand, GBP Aussie dollar long means you're going an anti-carry trade, or you're entering an anti-carry trade, meaning you have to pay for holding such a position, since the interest level here in the Australian dollar is higher than in GBP. So what I favor, also when I'm trading the money of my clients here in my managed account, what I usually do is I try to enter carry trades and not anti-carry trades. That's one of the reasons why I don't like to be, for example, short dollar Japanese yen. I just don't like it, because you have to pay for holding position for several days. And usually this is exactly the approach I'm trading. Usually I'm holding positions in currency markets longer, and usually on a swing basis here, instead of intraday trades. I mean, I traded it. It was okay. Nevertheless, I feel way more comfortable here trading FX pairs for a little longer time frame. And when you look at the reaction today in GBP based on the expectation, well, the thing is that obviously expectations play a main role when analyzing and writing down potential scenarios for such a huge and important event like the NFPs tomorrow. And that's one of the reasons why I did the following. First of all, you have to find out, okay, what does the market expect? And in terms of the NFPs, it's really, really easy, since we have with Bloomberg a great tool here at hand, Bloomberg.com, where you can go here to the so-called economic calendar on the Bloomberg markets, and well, then you go, well, let's just do it that way, okay? So let's go that way. So you go on economic calendar, and then you look for the news event you're interested in. In this case, it's here, the employment situation. You click on it, and you get everything you want. You have the non-farm payrolls, consensus range. But it's in fact, it's not about the about here the non-farm payrolls itself. I think the main and the key fact for tomorrow are the average hourly earnings here, month on month especially, probably also average hourly earnings year on year. You can see that the consensus here is 2%, 0.2%, while the consensus range is 0.0% to 0.5%. So there are several market participants or analysts who do not expect to get to see any growth in average hourly earnings, while there are several saying we'll see month on month 0.5%, meaning everything which is currently above 0.2%, should be considered bullish for the US dollar, since this will likely trigger further restrictive moves, meaning rate hikes of the Fed in 2018. While everything which comes in below expectation, or here in the lower bound of the consensus range, somewhere around 0.0, 0.1%, should be considered more bearish for the US dollar. That means, on the other hand, that probably the numbers itself, non-farm payrolls, probably don't play such an important role for tomorrow's non-farm payrolls reading. By the way, on top of that, you have to see here the consensus range after the hurricane here in the US. It's huge. It's 200,000. It's 200,000. The difference is 170,000. So the lowest being at 200,000 and the highest estimated 371,000. So meaning, all in all, this number here probably is overestimated right now. You shouldn't just watch this number, but really, if you want to understand what's going on here around the non-farm payrolls in the markets, and if you'd say, for example, it's a perfect example. Let's have a look here what happened last time. I mean, it was minus 33,000. That was the first time since 2010 that this happened here. So you'd usually expect the US dollar to sell off sharply, right? And what happened? I can show you what happened. It was the first Friday in October. This is, by the way, the US dollar index future on a daily chart. And you can have the numbers. I think it was here, the 3rd of. Was it? What is it? One second. I just have to see. When do we have the non-farm payrolls this month? Here was the 6th. Was the 6th. So you can see that all in all, yes, the market didn't react that bullish, even though it wasn't strongly bearish too. So, and this had mainly to do with the fact, and it could show you several occasions here. So this month probably makes some sense, but nevertheless, or makes some sense if you just look at the numbers, non-farm payrolls. But I can show you several occasions when we had a reading which was below expectation, but the US dollar reacted bullish. Respectively, we had readings which were above expectation for the non-farm payrolls, while the market, US dollar in this case, reacted bearish. That had mainly to do with the fact that the average hourly earnings right here are such a crucial number in terms of the inflation expectation, and so a very important number for the Fed to consider if they consider rate hikes or not. So meaning nothing more than, scenario 1 is the NFPs come in somewhere below the consensus and somewhere at the lower bound here of the consensus range, something like 200 to 250,000. The unemployment rate is somewhere between 4.2 to 4.4%. In fact, it doesn't matter, since it seems as if this number is not considered from the Fed at all. But, and this is the thing, the average hourly earnings are bigger than 0.2%. In fact, I somehow expect them to be above expectation. And that's one of the reasons why I don't consider EURUSD to be only bullish, but neutral to bullish. Probably, nevertheless, with this NFP reading here, somewhere with a retest of the region around 17 to 70.30. Nevertheless, I consider this region to be probably an attractive short. So you can see this also in the chart. And there we come to the head shoulder formation here. You can see that, by the way, right now, EURUSD is already rising here to new weekly highs. So currently the high can be found at 87. So probably we get another test of this neckline here and the region around 1770.30. Nevertheless, everything below 1850 to 119 or 1850, 1880, and below this right shoulder here should be considered bearish, and every bounce towards those lows here is definitely worth short engagements, I think. And that's one of the reasons why I carefully watch this region. On top of that, I have also sell stop here below the current lows of the post ECB lows, by the way. So if we're not making it to this region, nevertheless, if the NFPs come in and liquidity thins out, then I definitely watch this region here for potential short engagements. And that's one of the reasons why I want to be careful, since neutral to bullish means it's really bullish, but nevertheless, EURUSD currently the overall outlook is bearish, meaning everything below 1850 to 1870, 1880 should be considered bearish, meaning neutral to bullish it's really short term, but I carefully watch 17 to 1730 then. Dollar yen is should be considered bearish, probably drop as low as 111.70, 112 in the next days, respectively, in the upcoming week. If we break below 113, and but nevertheless, also depends on the potential risk aversion in the markets and equity. So if you look at, for example, the S&P right now, it's not huge volatility. In fact, right now, the Dow Jones is making back all of those initial losses, trading back above 23,400. So we look at the S&P. Well, sure. I mean, nearly making back all of those losses of this red candle here. So there's no real risk aversion in the markets. Nevertheless, have this in mind when trading Japanese yen. But let's have a look at the dollar Japanese yen itself. It's very interesting to note this, that currently we are already trading in this region. But I don't think, or no, I am very sure that, or highly confident that we won't make it above this region if the NFP is disappointed, especially from an average hourly average hourly earnings perspective, since dollar Japanese yen is highly positively correlated to the 10-year yield of US Treasury notes. And in this case, you expect yields to drop, meaning dollar yen should drop too. And on top of that, by the way, I consider it to be somehow a little skeptical. I know about the negative correlation of the Japanese yen and the Nikkei. So, and if I see this parabolic move here in the Nikkei, I expect Japanese yen to be under significant more pressure, which is not happening. Okay, so this is something definitely worth watching. And once the NFPs disappoint, dollar Japanese yen could be an outperformer on the downside, especially if we make it below 113, which is this level, because if we break below this level, then the next target should be found somewhere around 111.70, 112 first, and below that around 110.50, 110.77, 110.80. Yeah, so this is the scenario one. Gold is neutral to bullish. In fact, the market doesn't look that promising in gold, in fact. So let's hope that we will, in such a scenario, at least can make it back above 1,280.82. So currently we are already trying. And if we're not making it above this level today, and you can better see this region here on a 4-hour chart, then there's here, this is the region. Then we probably have a chance to see a final push above this level and a stabilization, and also weekly close above this level once the NFPs disappoint. So if they don't come in as expected, so yesterday, for example, ADP data came in good or solid, meaning that the expectations keeps on rising here. But the thing is, if now the NFP data set disappoints, then probably gold has a good chance to outperform on the upside and finally make it back above 1,280, 282, if we can make it above this level today. So we have a potential trigger here tomorrow, even though I consider the currency pairs, the Euro USD and also dollar Japanese yen, clearly favoring, by the way, Euro USD. I consider those two here way more interesting than gold. I have to be honest here, since the market structure just suits my trading way better. I have two other scenarios here. In fact, you can see that I didn't change that much, but I just changed here the numbers for the NFPs. Average hourly earnings stays the same. I think we'll come in better than expected. I don't know why. Don't ask me why. It's just a feeling, gut feeling. And that's one of the reasons why I consider the US dollar to be somehow probably exiting week better than expected. In such a scenario where we have a positive development here in our average hourly earnings, while the NFPs come in around the consensus, it's bullish for the US dollar, meaning Euro USD should be considered neutral to bearish. Possible break of the post-ECB lows target, so that means 115.70, some 75, and then we are targeting 115 and lower in the next week, respectively weeks. In dollar Japanese yen, we should definitely expect an attack at 114.50 here. And if we then see a break of this level, then it's likely that we are continue to move higher towards 115 to 116. In gold, we shouldn't be too optimistic then. Probably the current move here towards 1,280, 282 is probably just a fake out, and we probably keep on somehow drifting sideways here, meaning that the overall or the year-end rally, let's call it, I'd really like to see, by the way. So I'm not positioned yet in gold, but this could definitely change then in the month and the upcoming weeks here and around the yearly close, since gold usually sees a bullish seasonal pattern during this time. But this is something we'll discuss a little later then, and not today. But all in all, I don't expect too much action to happen if such a scenario happens here. But dollar Japanese yen could get interesting, since this gives us a good chance to clear this region here, 114.50, and push up to 115, 115.20, 115.70, probably 116. And then let's just see what behavior we get to see in dollar Japanese yen in this region. And the final scenario here. Oh, by the way, I'm sorry. I'm sorry. I have to change this. 1 second. You have seen it here. It's scenario 1. I didn't change it, but I have to. In fact, it's not scenario 1, but it's scenario 3, right? 3. Okay, and this is scenario 3. Also here, no change. Still the gut feeling around the average hourly earnings, but now the NFPs 350 to 400. So above consensus and also in the upper range of the consensus range here. In this case, EURUSD definitely bearish, and we should definitely wait for a break of the post-ECB lows. So a break below 116 again. We definitely should a bullish move in dollar Japanese yen. So in fact, the scenario 2 and scenario 3 are not that different from each other. And we have definitely a good chance of dollar Japanese yen then to move up to 116. Gold, this could get interesting, since this could mean, or such a scenario could mean, that we are attacking the region around 1,260, probably will be possibly attacked here. So right now it seems as if we can easily hold this region, but if the numbers really come in better than expected, that could definitely push yields higher. So 10-year yields in the US higher, which is negatively correlated, or gold is negatively correlated to such a scenario, meaning that on a yield which push higher should affect gold in a negative way. And this could then mean another move, and at least an attack of the region of 260 here in gold. If we break below this level, well, then there's further room on the downside, probably pushing us as low as 1,220. But right now, I have a positive feeling about gold. I can't tell you why, but all in all, I still consider chances to be higher that gold will push on the upside instead of the downside. Nevertheless, be really be aware of that the NFPs could somehow change this, especially if they push gold as low as the former NFP lows here. It's around 1,260. If we break below this, there's then definitely further room on the downside. And yeah, so these 3 scenarios are my scenarios for tomorrow. So these are the 3 markets I will watch: EURUSD, dollar Japanese yen, and gold. And let's just see. I mean, this is the funny thing about this. Some of you might say, how these guys here giving those numbers away and expectations, and analysts which are giving here their idea and delivering the input for creating such a consensus range. They are some wizards here, but in fact, they are as smart as we are. So in fact, they are just somehow having some modules. They run their numbers through them, and that based on that, they give out an expectation. But in fact, it's more like to, yeah, it's just like it's just giving a tip away, if you want. So and then just guessing the future. But all in all, you might have seen that there were several occasions, like last time here, that somehow no one really expected non-farm payrolls coming in negatively, that negative here. So last time the consensus range was something like I think was 0 to, that was the lowest expectation, to 100, probably 100,000. if I remember that right, and then they come in below the lowest guess here. That's a perfect example of that these guys are guessing too. And so all we can do here is create a scenario for us, what we expect, and then just see the numbers coming in, how the market reacts, and then act accordingly to our predefined plan, which is an already formulated. Yeah, and so that's it from mine. I just hope that you enjoyed this special webinar here, and I'd say happy trading. Watch your stops, and if you have any questions, please shoot me an email or contact me via Twitter. It's at Jens Klatt FX here, as you can see it. And so that's it from my end. Talk to you again then next week, or in the morning meeting already tomorrow morning in 10:30 at 10:30 a.m. GMT. YouTube channel from JFD Brokers. Just subscribe there to it, and you can listen to me again. And so yeah, that's it from my end. Happy trading. Watch your stops. Have a nice evening, and talk to you again then next week. I look forward to it. See ya, and bye-bye.